Good morning, everyone. Welcome to the Reserve Bank and to the November Monetary Policy Statement. I have with me Jeff Baskand, Deputy Governor, Head of Financial Stability, and John McDermott, Assistant Governor and Head of Economics. And today the Reserve Bank is leaving the official cash rate unchanged at 1.75%. This decision is made under the current Policy Targets Agreement, which I signed with the Minister on Tuesday. That agreement you will find on the inside cover of our published statement. Our decision is also in the context of the economic outlook, which overall is very positive. Looking at the global economy, the growth outlook is improving and inflation remains subdued. Commodity prices are relatively stable. Monetary policy and interest rates remain easy in the advanced economies, but that stimulus is gradually being removed. The exchange rate has eased since the August statement, and if sustained, will increase tradables inflation and promote more balanced growth. In the domestic economy, we're seeing strong employment growth, and GDP growth is projected to strengthen over the forecast period. We now have a weaker outlook for housing and construction, but this is offset by a continued high terms of trade and increased fiscal stimulus. In these forecasts, we have included estimates of the impact of new government policies in 4 areas. New government spending, the Kiwi Build program, tighter visa requirements, and increases in the minimum wage. The impact of these policies is essentially a first estimate, and these numbers remain very uncertain. House price inflation has moderated due to a number of factors: the LVR restrictions, affordability constraints, reduced foreign demand, and a tightening in credit conditions. Low house price inflation is expected to continue, reinforced by new government policies around housing. CPI inflation was 1.9% in September, although underlying inflation remains more subdued. Non-tradables inflation is moderate but expected to rise as capacity pressures increase. Tradables inflation, on the other hand, is relatively high now due to the lower exchange rate and increased oil prices, but this is expected to soften given our projection of ongoing low global inflation. We're forecasting overall CPI inflation to remain near the midpoint of the target range over the next 3 years. Certainly, longer-term inflation expectations are well anchored at 2%. Monetary policy will remain accommodative for a considerable period. However, numerous uncertainties remain, and policy may need to adjust accordingly. So now let's open up to see if you have any questions.
I take it and I understand that the first look at new government policy is very preliminary, but could you give us a flavour of the sort of the impact you see it having on growth in a net sense, with increased spending presumably offset by some impact of lower immigration?
Yeah, so we see the new government policies. As I say, these are very preliminary estimates, but essentially there is an additional fiscal stimulus relative to the picture we had last August at the August MPS. So government consumption, we're assuming, is higher by about 3%, and the overall fiscal stimulus we see is about 0.5% of GDP per annum over the next 3 years, over our forecast period. You're right, there's some offsetting factors, so that, for example, the migration policy will tend to have a somewhat steeper decline in net migration, but net migration is still positive. It's just a bit softer than we had forecast previously. Any other points you'd make, John or Jeff?
Well, just in terms of the changes in permanent long-term arrivals, it will have both an impact on demand and supply side of the economy. So, net, it's probably a bit of a wash, I would say, on that front.
What John's saying, that the lower migration will reduce demand as well as supply capacity. So there are offsetting effects, but overall that's a negative. But the overall impact of the new government's policies is a positive stimulus to aggregate demand of about 0.5% of GDP.
Hi there, Anna from Reuters. I noticed you guys made no mention of the review of the Central Bank Act and the addition of employment in the statement. I was just wondering what impact you see from that on monetary policy. Thank you.
Well, it's pretty early days because, the review's just starting, and so we don't actually have a change in our mandate as yet. But I would say, and I think this view is shared by my colleagues, that moving to a dual mandate is unlikely to have a major impact on the way that we run monetary policy. Currently, our approach we call flexible inflation targeting. So inflation is our primary objective, but it's not the sole objective, and we do look closely at the real economy and a whole range of economic variables. And so, for example, sometimes we're happy to see inflation move outside of our target band in order to promote the stability in output, employment, at the exchange rate. And this is a requirement in our policy targets agreement. So that's called flexible inflation targeting. We do allow and try and stabilise the broader economy, not just prices. Now, with a dual mandate, it may be that our approach becomes more flexible, more flexible in the sense of allowing greater volatility in inflation in order to promote more stability in employment, for example. So to that extent, there's these trade-offs, and there may well be situations where a dual mandate would shift our approach, particularly in situations where the labour market was sort of a long way from equilibrium. But in the current situation, I would say that the labour market is pretty balanced, and therefore I don't think a dual mandate, and if we had it right now, would make much difference at all to our current policy stance. Rob.
The other thing one of the things that changed with the last PTA was the bit more emphasis on asset price inflation, and of course that's become a bigger deal since that time. not just here but globally. Do you see that as being something that needs a bit more attention by the policymakers, even if it's not in the actual agreement?
Well, you're right. I mean, in the Reserve Bank Act, that we've always had, or since 1989, a section which says we shall have regard, monetary policy shall have regard to financial stability. And more recently, you're right, that was put into the policy targets agreement as well. So it's a relevant issue to raise, because financial stability is also something we need to have regard to, as well as the real economy and and employment. So we certainly would like to see that retained as an element in the Act and in the policy targets agreement, because we think financial stability is something that monetary policy needs to have regard to, even though we're not saying it should have an equal status in terms of as a primary objective, because the policy that, a prudential policy, a macro-prudential policy, is the primary tool for addressing financial stability, but monetary policy also needs to, keep an eye out for it. Does that make sense, Rob? You look a bit puzzled.
I've got another question which isn't hugely related, but you're making some assumptions here on that people will carry their previous expectations of inflation through, and that you're not going to see a turn in behaviour. How provisional is that assumption? Because there's quite a lot riding on it, isn't there?
Well, inflation expectations are very important. I'll ask John to follow up on this. And, in recent years with low inflation outcomes, that has had quite a bit of momentum in the system. But as I mentioned, the long-term inflation expectations have stayed close to our 2% midpoint, which is very positive from our point of view. So we think that that experience and those expectations that 1 to 3% inflation is now normal, 2% is normal, and we're not about to deviate from that. That really assists our policy, and we want to ensure that element is retained in the policy framework. Do you have anything to add to that, John?
Yeah, it is an important issue, but I think the way you phrased the question was, what do you think people are going to think in the future, which is always tricky. As you well know, inflation expectations are a critical part of monetary policy formulation and the inflation process. And we'll be looking at monitoring that as intensively as we have in the past, by monitoring, financial market prices. We'll be paying very close attention to all the surveys on inflation expectations, and also to our internal models of inflation expectations, which have proven to be a valuable part of getting the inflation forecast right over the last couple of years.
Governor, a couple of quick questions on the new forecasts today. You now expect inflation to reach the midpoint of your target a lot sooner, so next year. But you haven't made a really significant change to the outlook for the OCR. Could you explain that? Why the OCR remains on hold for so long, even though you expect to reach the 2% a lot sooner?
Well, these forecasts have sort of got quite a few moving parts, and there's give and take on different things. So quite a few things have changed since our August MPS, even though at the end of the day there's a lot of netting out, so that the interest rate track is very close to what it was before. I think in terms of the inflation, we have seen stronger traded goods inflation because of, one, the lower exchange rate, and two, higher commodity prices, high oil prices, and I think maybe some food price increases as well. So they've lifted the inflation track sooner than we had before. But we see that sort of dissipating, that traded goods inflation, to be replaced by the underlying trend in sort of non-traded inflation, which was the driver of our previous track, sort of coming through more gradually. So there's sort of a replacement of one with the other as we move through time.
Well, just that brings us, I think, to the dollar then. I mean, your comments today sound a lot more relaxed than you have done for quite some time. Can you just put a bit of context around that? Are you quite happy with where the dollar is now? Would you like to see it fall further? Would you like to see it stay where it is? What's the thinking there?
Well, yeah, so since last August, we've had about a 5% or so depreciation. We're happy to see that take place, and we think that the currency is now sort of closer to a sustainable level than it was previously. So, you know, we're happy with this sort of level of the currency. We think it's in the vicinity of a sustainable exchange rate.
Does that say fair value, more or less?
Yeah, I would say that. That's right. Fair value, in the vicinity of fair value.
Governor, could you talk about Box E, the Reserve Bank's look at the potential impacts of the new government's policies? And in particular, whether you think the Reserve Bank would have to lean against the loosening fiscal policy, the impacts of the minimum wage increases, and the visa changes. When I say lean against, you know, run a tighter policy because of these changes.
Well, in these forecasts, we're seeing, you know, a greater fiscal stimulus and a weaker private spending track, in particular around residential investment. But, you know, one is not causing the other. It so happens that fiscal is sort of replacing it's a weakness in private spending, resulting in particular from constraints in the construction sector. So it's not a situation where government spending is crowding out private spending. But of course, if the fiscal stimulus was to become much greater, then you could have some sort of crowding out developing. But that's not the case in these forecasts, and so we're not seeing that with the interest rate track. And we're saying that, you know, the sort of that additional fiscal stimulus that we're seeing is quite can be accommodated in the current the current scheme of things. And, you know, interest rates are still essentially in quite an easy mode. Monetary policy is still in an easy stance, and that's expected to continue for some time. Anything to add, Jeff?
I think you've made the point that really we're looking at the total aggregate demand picture, and the interest rate track reflects that, and as the Governor has indicated, it's little moved, slightly up at the outturn at the end period, reflecting just where we think the output gap and capacity pressures might be getting to at that time, but it's a long way out in the projection period.
In the past, the Reserve Bank has looked at how the migration changes in the last few years have affected inflation in the labour market, and that the large number of particularly young migrants in the last few years has helped increase the labour supply, and therefore surprised a few people by not increasing inflation as perhaps it was expected in the past. Given this 20 to 30,000 projected cut in net migration from government policy changes, what sort of inflation impact do you think that might have? Because on the face of it, it could, in theory, slow demand and slow the economy and inflation, but on the other side, reduce supply and, potentially increase wages. So how do you see that balance?
Do you want to
Yeah,
try
was-
that? John?
Yeah, I mean, this is the point I was referring to earlier. I mean, what matters here is the composition element of the arrivals and departures. So whether they're young, whether they're entering the labour force, or how much demand, aggregate demand extra to the economy, which is what you referred to. And it was a big change. So we had last time the net migration profile actually didn't really add to aggregate demand as much as the previous two cycles. And I think we're going to have to be on guard for the same type of phenomena this time. Is where does the net demand and supply profile go? For the moment, in these forecasts, what we're assuming is that the two forces roughly cancel each other out. So there's a very, very small change on net in terms of its pressure on resources and inflationary pressure. And it could well change, but the key to understanding that change will be to see who is arriving, who is leaving, what are the age profiles, do they have work visas, what skills do they bring, and a whole raft of other sort of criteria.
Just also finally on the box E, the minimum wage increase is looked at, but there's no mention of the potential for more big pay equity deals like the one we had with aged care workers. The government has thrown out the pay equity bill and is going to write a new one which suggests more of these big pay equity bills coming through. Do you think there's a chance that that could further increase the wage inflation effect from beyond the 0.2% you've included in this forecast in box E?
I think that is a potential risk, yes. So in our forecast, we've just allowed for the direct effects of the minimum wage increases, as you say, about 0.2% per annum. And so if there's sort of flow-on effects, bump-on effects from that, then that would cause additional pressure that is not included in the forecast. So that's a risk.
And just one final one from me on full employment. You mentioned at the beginning that you saw the labour market as near equilibrium. The Finance Minister wants to see unemployment drop below 4%, where he said that. Do you think that would increase inflationary pressures, i.e. is that below, is that more than full employment?
Well, that's an interesting question, Bernard, because the estimates of full employment, or what we call NAIRU, or the natural rate of unemployment, are quite uncertain, and we're doing work on this. And particularly if we're moving towards dual mandate, etc., we need to do quite a bit more work on pinning down some of these numbers. Presently, estimates of neutral or natural rate of unemployment vary, I would say, in the territory of sort of between 4 and 5. Current unemployment is 4.6, as you know. And so, we don't have a precise estimate, is what I'm saying, of where the sort of equilibrium is. And we need to try and do work on that. Now, the government is saying that, they would like to see unemployment below 4%, and that's a very worthy objective, of course. But that, in part, that reflects attempts to use government policy and structural policies to reduce the equilibrium rate of unemployment, not just the actual rate of unemployment. And so, monetary policy can't affect the the equilibrium rate of unemployment. We can have short-term influence on sort of through the cycle, but if you want to get the equilibrium rate down on a sustained basis, then the government will need to work on with various policies, like education, etc. And that makes a lot of sense, but it's not something. And this is something the minister has said. He's not saying that he's expecting monetary policy to achieve a sustained lower rate of unemployment, say below 4%.
But on the face of it at the moment, below 4% would be inflationary from your point of view.
Well, if the if the equilibrium or NAIRU was between 4 and 5, then the further you get down below that, then that would tend to be inflationary. Unless you can bring in other policies to try and get the equilibrium to a lower level.
So would you say then that for the government to sustainably go for less than 4%, they'd need to make policy changes to reduce that equilibrium rate below the 4%? Because at the moment it's...
I would say so, yes. Yeah.
Yeah, Bernard, that number, the natural rate of unemployment isn't a fixed universal law. It changes over time. It changes because the proportion of young people in the workforce can be higher, and they tend to find getting a job, takes longer. It can be due to changes in technology, making it harder for unskilled workers to get work. The forces of globalization can alter that number. So it's very, very variable, and these are the things the bank would have to be monitoring to see what's changing. And I suspect you could pick a number today, but in a year's time the number's different.
Could you argue, though, because we've got such strong employment growth and relatively low wage growth, that maybe you and the Treasury and everyone else has overestimated where that equilibrium rate has been because of technology changes and globalisation?
Or even insecurity in the labour market. And actually the bank has been very cautious in its view about what it understands about the labour market. So we've never specified a specific number because we're well aware that number does change all the time. And so we do look at the labour market, we look at the forces, what's playing out, as well as looking at information from goods markets and so on.
As has been the case around the world, I mean, I think through this economic cycle, what you've seen is estimates of equilibrium rates or natural rates of unemployment declining, and there's been a lot of work, obviously, in the United States where they do have a dual mandate. And the governor, head of the FOMC Board of Governors, Janet Yellen, is of course a labour market economist, and she's done a lot of work with her research team there, coming to a view that the rate's lower than they had originally assumed. But as John says, they can also rise as policies change. Just the general drift in recent years has been to assume that they've been falling.
Hi, just another question for me. I would like your views on the ban on foreign ownership of existing houses, whether you're happy the government's doing something to bring down house prices, and whether you think it will have an impact on the market. The trade minister said that it probably won't short term. Thanks.
Well, there are a number of policies, as I mentioned at the outset, the government's introducing, which we think will contribute to a moderation in the housing market. That's one of them. The other around the tax policies, the moving out the bright line test, and just the setting up of the tax working group with a potential impact on the tax regime around housing. So we think that will help to keep investor demand for housing at a moderate level, and potentially other things such as the migration policy and the measures on foreign ownership will also contribute to that moderation. So you'll see in our projections that even though there's a lot of risk around this, that we are projecting house price inflation to stay quite low. Any other questions?
In that case, would you expect to wind back the LVR restrictions? And are you still going to push to get the DTI added?
Well, the LVR restrictions, we're certainly reviewing the restrictions and the criteria that we would adopt for their removal, and we'll be saying more about that at our financial stability review, which is in a couple of weeks. So we'll talk a bit more about the LVRs and those criteria at that point. On the DTIs, these are debt to income ratios. We've had a consultation, as you know, and there are a few issues that are raised in that consultation about, how we would make such a policy work. We still think that it makes sense to have some sort of debt service, macroprudential debt service tool in the macroprudential toolkit, but at this stage we're planning to sort of wind in that issue into the macroprudential review, which we're conducting jointly with Treasury over the coming several months. So, we're not certainly given the conditions in the housing market, we're not looking to obviously introduce any new macroprudential tools, but we think, from a long-term point of view, it still makes sense to have an instrument of that sort, and we'll be considering it in the review.
Do you think that the housing market has moderated enough and you're confident enough about that moderation to be able to relax the LVR tools and not,
Well, Bernard, as I said, that's something that we are looking at and reviewing at present, and we will address that question at the Financial Stability Review on the 28th, is it? 29th of November.
So do you think there's a chance they could be removed sometime in the next year or two?
Well, when we introduced them, we certainly said that these were a temporary measure and that at some point we would look to remove them. So that's right. But I think it's also fair to say that if we're looking to remove them, that wouldn't be done in one hit. It would be a gradual, a more cautious approach.
And there's no suggestion of replacing one with the other, if you like, of getting rid of the LVRs but having a debt service limit?
I think that's unlikely.
Just wondering how you feel about the prospect of having external experts on the policy committee and whether there are any thoughts or issues around that at all for the bank?
Well, that's an interesting issue. Certainly, this issue with in terms of the review. Part of the review is to have a policy committee, and potentially with externals on the committee. And so, in terms of a policy committee, we certainly agree that the Act should be changed to accommodate a committee, because we already operate with a committee, and the current governing committee is what you see here in front of you. And so, we would like the Act to reflect that. The issue of externals, I think that, there are pluses and minuses, quite a few different views, and we'll have to work through this in the upcoming review. Clearly, I think the benefit is more diversity in the decision making, but there's potential issues we think about, in a small country, finding the appropriate expertise that's not conflicted, that's politically independent, etc. You know, sort of making it work is sort of the tricky issue. I think that probably we see a more important issue is trying to make sure that the committee has a collective responsibility rather than having an individualistic committee. Sometimes you see policy committees around the world or in other central banks where everyone's out, you know, with different views in public, and it turns into a bit of a circus. And that's the thing that really we're more concerned is avoiding that. Sure, get diversity and different views, you know, publish minutes, whatever, but have collective responsibility rather than everyone heading in different directions.
Is that to say you don't favour sort of publishing individual votes or having a vote structure per se?
Well, that's part of the aspect. We don't have a firm view on that. That's sort of the thing we have to work through with Treasury in this review to figure out, you know, a framework that makes sense.
We had some concerns about the broader committee.
Well, yeah, the concerns is because we think the current committee, internal committee, works pretty well, and so if it's going to be changed, we want it to improve it, not worsen it. So that would be the challenge. Yeah.
Right. Thank you.
When you mention that it's a bit of a circus for some other central banks, what sort of things are you talking about there? Because they always,
well, if you have
do something.
externals, and you know every week you see that the external members and internal members are giving speeches, and so there's running commentary and a focus of the media and the financial media on the different views and where it's coming out for monetary policy. It brings additional focus on monetary policy, which we think, monetary policy gets a lot of coverage already, but monetary policy is not the only game in town. There's a lot of other important policies that are relevant to the economy, and if you have a diverse range of people in the committee who are all giving different views and bringing the focus of your attention more onto monetary policy, I'm not sure that's a very productive way to go. It also potentially undermines the sort of reputation and credibility of the institution. That's a risk, I'm saying. That's a risk.
I think if I just add a touch of nuance to that, it's the concern that the issues that we set out in the monetary policy statement are the focus of the discussion, the range of uncertainties and risks that we spend a lot of effort trying to articulate, as opposed to getting a difference of view between individuals. That seems not to be the key point, and you can get personality dimensions where the individuals are more the focus. Are they a dove? Are they, a hawk or whatever else? As opposed to what are the issues that the bank was considering in terms of risks around how household spending is going, the labour market issues we've been talking about. And I think that's what Grant's is alluding to here, which is we'd rather have that focus on the substance of it.
It's like, Cabinet operates with collective responsibility. They have different views and they have a big scrap inside the Cabinet, but then outside it's a unified story. It's a collective responsibility. We just think it should be a similar approach for the Monetary Policy Committee.
Is it the case that you could see the risk of potentially more volatility in financial markets as a result of that sort of a structure?
Well, if you moved away, if it was individualistic and everyone was giving different views, there would certainly be the risk of that. Yeah.
If you can say, where are we with the new governor selection and proposal process?
Well, I can't say much about that. I'm not involved with it. That's the board that is running the process, and then then the minister obviously makes the appointment at the end of the day. So you need to talk to the minister and the board about the timing of that. But clearly the aim is that I finish at the end of March, and the aim is to have the new governor appointed well ahead of that.
And you're still
time.
expecting to go March 26?
Yes, yeah.
Just on the governor as well, I was just wondering, in terms of the process, if the board makes a recommendation to the finance minister and he rejects it, is that made public?
You're getting into detail that I don't really want to get into. That's conjecture in any case. But the process is that the board makes a recommendation to the minister, and the minister appoints.
Say well before March. What does that mean? Could we have the new governor named before Christmas, for example?
Well, that's possible. So, but I'm not sure how soon that. But the process is well in train. So I would certainly expect the announcement to be made well ahead of next March. Whether it's ahead of Christmas, I'm not sure. Okay, well, thanks very much for your time, everyone.